Welcome to our first video for our course, Accounting 349, here at Flagler College, Tallahassee. And in this video, we're going to be looking at transactional analysis. Our first topic that we're covering in the course is a review of the bookkeeping process. You've been exposed to this in your earlier courses in Principles of Accounting. Financial accounting begins with the collection of data. In the past, the data consisted of source documents, paper. Today, more than likely, most of the data will be in electronic format. The data will relate to many routine types of business events. In retailing, you can think of a cash register at the store. As customers come up to the cash register, sales information is collected. Well, these are transactions. These transactions are automatically fed to the headquarters. We can have similar type systems set up to capture the costs relating to routine events like labor costs, material costs, overhead costs. All of this data that is routine in nature will be pumped into the accounting information system, where predetermined routines will do the transactional analysis. Occasional transactions, such as the purchase of a building or equipment, well, these will generate different types of source data. These will be analyzed by an accounting or accounting staff people. And this process is called transaction analysis. And it's looking for the effect of an economic event on the financial reporting of a business. And this is accomplished through the use of the accounting equation. Once the transactional analysis is done, well, then we will take over into the bookkeeping process, which records the event in the database. In the old days, the database consisted of two books, the journal and ledger. Well, obviously today, the database is going to be electronic. The database will maintain a running balance in each of the accounts. At any given point in time, we could ask for a report that is called the unadjusted trial balance. Accounts will then apply accrual accounting methods to the unadjusted trial balance to make these adjustments for prepayments and accruals, and that will lead to changes in the account balances, and the updated balances will be produced in what's called the adjusted trial balance. That adjusted trial balance is used for the financial statements, or statement of financial position, or balance sheet, or statement of operations, or income statement, statement of cash flows, and statement of changes in owner's equity. Financial statements are the reason that financial accounting exists. Financial accounting is for external users. We're going to present these financial statements to our users. They're going to take past historical events and use them to make future-oriented decisions. At the end of the process, we need to close out certain temporary accounts. These get closed out to our retained earnings. A new updated set of balances are made so that on January 1 or the first day of the new year, our temporary accounts such as sales and expenses, dividends, all will begin with a zero balance. And the process starts all over again. And that's why we call it the accounting cycle. All right, so let's take a look at our accounting equation. Our accounting equation is simply assets equal liabilities plus equity. And we'll discuss the definition of assets and liabilities. But for now, let's take a look at the components of equity. There are two components to equity. Paid-in capital, that is money and property that the owners have invested in their business. The other component is retained earnings. And retained earnings are simply earnings that have been retained. Well, what do I mean by that? Retained earnings is made up of revenues. That is the sale of goods and services in the normal course of business operations. We may occasionally have gains. Gains is when we receive more for the sale of an operational or investment asset than it's currently being carried on the books. We have expenses. These are costs related to the operation of our business or financing the business. And these costs are matched to revenues using the accrual accounting method. And these costs, when matched, become expenses. And we have losses that occur when we sell operational assets or investments for less than they're being carried on the books. Well, you will recognize that these four items make up net income for a period. Net income increases retained earnings. Well, owners have a choice. They can take all of the net income and put it back in the business, or they can take all or part of it out in the form of a dividend. So we can say that retained earnings will increase by the amount of income for a period minus dividends paid in the period. So let's look at our definitions. I'm not going to read this to you. You can read it for yourself, but notice that this is a rather complex statement. Assets are one of the elements of the accounting equation. They're the elements that will be reported on the balance sheet. But as we go through intermediate accounting, we will be looking at various types of assets, and this definition will become clearer to you. For now, let's keep it simple. Assets are property, a lawyer would tell you. I like to call them stuff. You could have tangible property, things that are real, cash, buildings, land, equipment. All these can be seen, felt, sometimes smelled. We have intangible property. These are invisible, you cannot see them. Things like a promise to pay, an IOU. Well, in your prior accounting class, you learned the term accounts receivable. Well, that is a promise to pay, often not based on a written legal agreement, but by a business agreement between two parties, enforceable by courts, but yet a casual, informal arrangement. And you could have more formal legal rights. You could have loans to third parties that are signed with a promissory note. You could have things like patents and copyrights, franchise agreements. And as we will see later in Intermediate 2 and then really focus on in Advanced Accounting, something called goodwill that occurs when one business buys another business. So we could have our tangible property and we could have our intangible property. But is everything, every resource we have, an asset? Well, no. All been to the Christmas party where the boss gets up and says, our company's greatest assets are our workers. Well, do the workers and their knowledge show up on the balance sheet? Well, no. So we'll keep that in mind. One of the limitations of financial accounting. All right, here's the definition for liabilities. Just want to point out two things. A liability has to relate to a past transaction or event. We do not recognize future transaction or events. That's going to come into play when we look at things like interest on loans. And they have to be a present obligation. But be careful, these does not mean that it has to be a legal obligation. In accounting, we consider substance over form. So liabilities are what we owe, loans that we take out from a bank, less informal type of debt arrangements like accounts payable where we agree to pay a vendor. And we also have these possible debts, or what we call contingent liabilities. And these are things that are going to be probable to require us to make a payment sometime in the future. And we will study this in Intermediate 2 to determine when we have to accrue these types of contingent liabilities. So we have money that we owe to banks, formal agreements, less, shall we say, informal agreements. And here this accident could trigger the recognition of a liability that we know existed now because of this past event, but the legal obligation is yet to be formed, but we believe it's probable, so therefore, to be conservative, we're going to recognize it now. Finally, we have equity, which we spoke about, and the GAAP definition here talks about being a residual amount. Well, what does that mean? Well, if we take the accounting equation and we bring liabilities over the equal sign, we can come up with this algebraic equation. Assets minus liabilities equals equity. You can think about it on a personal term. You've heard the phrase net worth. And your net worth is your assets minus your liabilities. Well, what are you worth? Well, as a college student, somebody working, going to college, you probably don't have a lot. But as you grow, your net worth will grow. You'll have things that are easily measured, money, cars, homes. Then there's other worth that are not so easily put on a balance sheet. Things like your education, your knowledge, your experience. All right, in transactional analysis, we'll need first to look at what is a business transaction. And a transaction, according to GAAP, is an economic event that impacts the financial condition or result of operation. In other words, the balance sheet or income statement. Again, to have the effect on these, it has to have an effect on the accounting equation. And a transaction has to affect two or more accounts. Why? Well, because remember, we have two sides to the accounting equation. Always has to be in balance. Every transaction has to have a balancing effect on the accounting equation. And we'll see that when we get into bookkeeping, debits and credits, and creating journal entries. So what are accounts? Well, you've probably seen many accounts in your earlier accounting class. For assets, we have things like cash, accounts receivable, accounts payable. Individual transactions are categorized and placed into these accounts. We keep a balance in the ledger. Companies will establish chart of accounts that lists all of their accounts. Not all of the accounts in the chart of accounts will show up on the financial statements. Instead, we'll take similar accounts. For example, a business might have 25 or 30 different bank accounts. Well, we'll group all of these together and present one element on the balance sheet for cash, not 25 separate cash accounts. So that is our accounting cycle. We'll be working our way through it in our additional topic 1 videos and working on problems relating to it in the class. Most of you are very familiar with transactional analysis, so I'm going to have a separate optional video relating to this textbook problem 2-1, where we'll be doing transactional analysis. So if you need a little refresher on that, by all means, please view that video.